This video will help you understand how to minimize the impact of taxes throughout your retirement through tax bracket management. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. Now, while one is in the accumulation phase of their career where they're earning more income, accumulating more assets, etc., there's a little bit of play in the joints as to how one can mitigate the impact of taxes. However, once somebody transitions into the decumulation phase, oftentimes just called retirement or the distribution phase, you have way more control over the taxes you'll pay because a lot of the resources nowadays that you'll have for retirement income, you're allowed to control turning on and off the hose of income or distributions from those various assets. So in today's video, we'll touch on taxation at a high level, how that applies to the most popular forms of assets and income for retirees, and then ultimately what play in the joints those retirees have for distributing more or less from particular resources. So let's jump in. So the concept of tax bracket management refers to the ongoing process of prayerfully deciding what income sources you're going to pull money from so that you are minimizing taxes over the lifetime of your retirement. Now, theoretically, you could tax bracket manage your entire life, but as I mentioned earlier, you don't have as much control during the accumulation phase as you do in the distribution phase. And this concept becomes all the more popular for retirees because they have a finite amount of time that they can't make a ton of mistakes. And by definition, any money you're paying to the IRS in excess of what you have to is money that's decreasing the financial security of your retirement longevity. To successfully execute tax bracket management, you're going to need to know three things. Number one, how the federal income tax system works and how your local state income tax system may or may not apply. Number two, you'll need to know how various sources of income and how various distributions from assets factor into said taxes. And then number three, you'll need to understand what play in the joints or what control you have as a taxpayer for when you are or are not going to take distributions from these various sources. You'll need to add all three of those concepts together to successfully minimize the impact of taxes throughout your retirement through tax bracket management. First, let's cover taxation at a high level. And for today's purposes, we're going to focus on federal taxation because every state may or may not have their own nuanced applications, although some states, like Washington State, doesn't have a state income tax. But they have other taxes like a Washington State capital gains tax, and I'll link above here to an explainer video on that if you have more questions. So first and foremost, federal income taxes are done on a marginal basis or on a bracketed basis. What that means is all of your income isn't assessed a flat tax rate. Instead, the first chunk of income is taxed at a particular rate, the next chunk of income is taxed at another rate, and so on and so on and so on. And the higher the brackets, the higher the percentage in income taxes. And not only does that apply for ordinary income, but it also applies for long-term capital gains. I'll link above to an explainer video that talks about how ordinary income and capital gains play together relative to how much you actually will end up paying in taxes. But for today's video, let's look at the 2025 federal income tax brackets combined with income and capital gains. So as you can see, for a married couple filing jointly, the first $23,000, really $24,000 to keep it simple, is taxed at a 10% marginal tax rate. Above that number, you're no longer paying 10% in taxes. You're paying more. On the ordinary income side of the house, if this family goes from making 24 grand to now generating about $97,000 in total ordinary income, the first $24,000 is taxed at 10%. The next, what would that be? $77,000 is taxed at 12%, and so on and so on and so on. And you can follow the brackets to see ultimately how much somebody would pay in income taxes based on how much money they made. Now, long-term capital gains are also done on a marginal basis, although for most taxpayers, using about 15% is a pretty safe bet. If this retired couple, even if they're married filing jointly, had no income at all, maybe it's between the ages of 60 and 65, they've got no sources of income, yet they're pulling distributions from, let's say, an investment account, and they're generating long-term capital gains, well, according to the IRS, they could generate up to about $97,000 in long-term capital gains and pay nothing in taxes. And that's because capital gains up until you surpass $97,000 of long-term capital gains are taxed at a 0% bracket. Now, for most retirees, they're going to have some level of ordinary income, and so that's going to set a bar, and then long-term capital gains are going to stack on top of that, and then they are applied whatever long-term capital gains rate applies, which usually is around 15%, although effectively it could be less. Now, like I said, I've got an explainer video that breaks down that concept in a little bit more detail, but just at a high level, understand that ordinary income taxes and capital gains taxes are taxed on a marginal basis. The more you make, the more you pay. Now, the most popular sources of ordinary income for a retiree are going to be maybe pension income streams, if they're still working part-time, or maybe there's some income there. Social Security, to some degree, could be seen as ordinary income. To keep it very simple, it's partially taxable, and we'll talk more about that later. The most popular sources of long-term capital gains for retirees are, number one, going to be the sale of any business. Potentially, they're selling their business at retirement. Generally, all that's going to be considered long-term capital gains. And if they do an installment sale, then they'll need to recognize said gain over a particular amortized period of time. Maybe 5 years, 10 years, 15 years, whatever the buyout period was. Retirees generally might also have some investment securities, and if they're generating capital gains in there, that could also be a source of long-term capital gains for those folks as well. And then lastly, generally this is the biggest impact, is the sale of a primary home, and you're going to generate capital gains on that. Whatever they bought the home for is considered their basis, and if that was 30 years ago, odds are their property's worth way more now, and whatever they bought the home for, and they can add improvement costs to that as well, and that'd be considered their basis. Anything they sell the home for is considered their total value. The difference between that is considered their long-term capital gain, assuming they had the home for at least a year. I'll link above to an explainer video that talks about how you can actually apply up to about 500 grand in capital gains exclusions on the sale of your home. But philosophically, this is how federal income taxes work at a high level. Now let's touch on the main sources of income and distributable assets for a retiree. Some of the main assets that a retiree might have walking into their retirement are going to be any sort of pre-tax retirement accounts, things like 401ks, IRAs, inherited IRAs, those all are pre-tax. They might also have some level of Roth assets, so Roth 401k, Roth IRA, Roth inherited IRAs. They might also have some level of non-qualified investments or taxable investment accounts, things like joint investment accounts, individual investment accounts, brokerage accounts, or stock plans from their prior employer. From an income standpoint, they might have things like pension income streams from maybe a private company that paid a pension. They might have worked for any sort of like public government or municipality that gave them a public sector pension. They might have purchased some level of annuity that pays them an annuity income stream. And while we're not going to dive deep into these right now because there's a bunch of compliance behind talking about this online, but there could also be some level of like reverse mortgage type structure that provides them some level of fixed income, for example. Another income stream would be Social Security income, and we'll touch on in a little bit how that's taxable, but in some regards it's income taxable, and in some regards it's not income taxable. So we'll touch on more of that later. And let's touch on how these are all taxed. So generally, any pre-tax retirement accounts are going to come out income taxable. And so those charts we looked at earlier, that's going to start filling up those income tax brackets. Now, potentially, if there's like non-deductible IRA money inside their pre-tax IRA, well, that money would come out without taxes, but I don't really see a ton of that for the retirees I work with nowadays. On the flip side, generally Roth retirement accounts are going to be entirely tax-free, although there are some cases with various seasoning rules where a retiree might still owe income taxes on the distribution for those. In addition, if they have an inherited Roth account, again, if it doesn't meet particular seasoning rules, there could be some income taxes that apply, but in all my years of doing this, I've never seen income taxes actually paid on Roth account distributions, although it technically is possible. I'll link above here to how a Roth retirement account might be income taxable, as well as I'll link above later on into how the 5-year seasoning rules could play a role. Taxable investment accounts are actually completely tax-free whenever you're pulling money out of them. However, in order to pull money out, something most likely will have needed to have been sold and turned into cash. And if the markets are doing well and you sell for a gain, you'll probably be paying some level of long-term capital gains, maybe short-term capital gains, maybe there's interest income or dividends you'll pay taxes on, etc. So while the money accumulates inside these accounts, you'll be paying some level of taxes, but technically to pull money out of these accounts, there are no taxes. Pension income streams, for the most part, are going to be 100% income taxable. And same with annuity income streams. Now there's some nuance because some annuities are like Roth annuities and some annuities are what are called non-qualified annuities that accumulate based on your own contributions on an after-tax basis. So then a portion of the distribution is tax-free and the vast majority most likely will be income taxable. And that's what's called an exclusion ratio, and you'll have to dig into the specifics of your annuity to know if it's a non-qualified or if it's a qualified annuity. We touched on reverse mortgages. That money is all considered non-taxable as it pertains to claiming it as income. Now, with regard to Social Security taxation, it actually depends on how much income you're showing from all these other resources. So the more money you show in income, the higher the percentage of your Social Security income stream will be considered income taxable to you. And I'll link above to an explainer video that breaks down how Social Security income is considered taxable or not to you as a taxpayer. But to keep it very simple, the more income you show on your tax return, the more of your Social Security income is going to be considered taxable income as well. And I guess one more asset I forgot to mention would be any sort of like life insurance contracts. Withdrawals from a life insurance contract are tax-free until you have exhausted your cost basis. At that point, any distributions above and beyond that are either going to be income taxable if it's a withdrawal, or if it's a loan, similar to a reverse mortgage, that would be a non-taxable source of income. Unless your life insurance contract is called a modified endowment contract, which at that point, all these cool tax benefits are flipped, and the first money you pull out is income taxable earnings, the last money you pull out is tax-free basis, and any loan that happens is considered income as well. So if you're planning to use your life insurance policy for income at some point in the future, you probably want to stay away from modified endowment contract, classification. So that's how the major resources for a retiree are going to be taxed. Now let's talk about how one can control the distributions of these assets. So for pre-tax retirement accounts, this money is going to be entirely ad hoc up until you achieve what's called required minimum distribution territory, or you start your required beginning date. This is the time when the IRS will force you to start taking distributions out of your pre-tax retirement accounts because theoretically you've never paid income taxes on this money. If you inherited an IRA, however, and I'll link above to those explainer videos, you'll either have stretch required minimum distribution requirements, aka you'll have to take money out every single year as soon as you come into this money, or you'll have to fully liquidate the account within 10 years, or a combination of the two, depending on who the person was that passed away and your relationship to them. Roth retirement accounts are completely ad hoc as well. You can pick and choose when you want to pull this money out, and there's no required minimum distributions on Roth accounts, not even Roth 401ks. So if you're reading that information, you're reading outdated information. Unless again, this is any type of inherited Roth account, which at that point you would have required minimum distributions, or you would at least need to liquidate the entire account within 10 years. Taxable investment accounts are entirely ad hoc, and there's never a time that you're forced to distribute money out. However, you don't necessarily get a choice as to whether or not you're going to pay capital gains and interest income and dividend taxes as the money accumulates. There's a little bit of play in the joints there about controlling those taxes. Namely, if you're worried about capital gains, well, theoretically, never sell anything. Or if the market is down, that might be a prime time to do what's called tax loss harvesting, and I'll link above to an explainer video on that. And then based on your investment security selection, that could also dictate the taxes. Whether you choose more dividend-heavy investments, well, those are going to kick off more dividends and you're going to pay more taxes. Or maybe avoiding interest-bearing investments like bonds or CDs or things like that that kick off taxable interest. And then lastly, if you move your security selection more towards exchange-traded funds or ETFs versus mutual funds, odds are you'll probably be recognizing less in capital gains taxes as well. Pension income streams don't have a lot of flexibility. Once they're on, and generally, government provided pensions or private pensions are going to kick off income as soon as you retire or achieve a particular age milestone. Annuity income streams, on the other hand, those have a little bit more flexibility. Generally, you get to choose when you want to turn on the income. Usually, the longer you wait, the higher your payment's going to be. And once they're turned on, they stay on forever, or until you die. Social Security has some level of flexibility as it pertains to when you do or don't want to turn on the income. Now, like everything else, once it's on, it's on. And we touched on earlier how you can control some level of this taxation, namely, depending on how well you control the other sources of income. But your biggest flexibility opportunity is going to be choosing when to file, 62, or do you delay all the way till 70? Now, keep in mind, if you are a spouse and you are benefiting from 50% of your spouse that earned all the income, their Social Security benefit, there's not going to be any benefit to you to wait to delay your benefit past age 67. You don't get increases after that. But if you're the primary wage earning spouse, you might benefit from waiting to delay past the age of 67 up until age 70. Reverse mortgages are flexible for when you want to turn those on. There's no mandatory requirement that you do that ever. And then life insurance to the same degree is super duper flexible. And it allows you to take ad hoc distributions as well. You can either choose to take out a bunch of money or none for the rest of your life. Even if you're doing a loan, you can take out a certain amount of money and then not take out any more after that, unless you turn the cash value of this policy into an annuity. And that'd be through the use of what's called the 1035 exchange. And that's essentially where you take the cash value dollar amount and convert it into the present value of an annuity income stream. You basically trade your life insurance policy for an annuity policy. At that point, then the annuity falls into the annuity rules, and you can either control turning on or off distributions, but once you start, it's probably not going to stop. And again, fully income taxable most likely, if not at least mostly income taxable. We'll touch on some real-world examples on how to leverage tax bracket management in our next video. Today's video, I just want to set the foundation for how to understand these various sources. But ultimately, as we wrap up, I hope you walk away understanding that you have a lot of control, assuming you have a diverse amount of assets in retirement, to control the taxability of your retirement. Essentially, you want to marry your understanding of the federal tax system with your understanding of the assets you have and resources you have for retirement, and marrying that also with the understanding of what play in the joints or flexibility you have with all these various resources. You put all that together, and then you can successfully execute tax bracket management. From a calls to action standpoint, of course, I would take stock of what you have available or what you project you will have available to you walking into retirement. Do some preliminary analysis around what income you won't control and you just have to factor into the game, and then what resources or income you could maybe control. And think about proactively how you're going to minimize taxes throughout your retirement. Of course, I'd never recommend planning by default. That's a great way to end up paying way more in taxes than you have to. And I'd also caution using your classic off-the-shelf financial planning software to do this. A lot of financial planning software, and I have interviewed a lot of them, use default liquidation strategies like, well, all of your income for the first half of your retirement is coming from pre-tax retirement sources, then it's coming from your brokerage account, then it's all coming from Roth income. And I get from like a planning standpoint, that's really easy to understand. In reality though, that's a great way to overpay the IRS, because it's probably not going to be in your best interest just to dogmatically say, I'm taking all my money out of this resource until it's gone. So hopefully that was helpful. If you have further questions, drop them in the comments below or get in touch on the website. We'll help you get squared away. Have an awesome rest of your week, and we'll talk to you later. Bye.